Good afternoon and welcome to Azzad Asset Management's 2017 Investment Outlook webinar. Today we're going to be hearing from Christian Greiner, Azzad Ethical Fund Portfolio Manager with Ziegler Capital Management, about what investors could expect in the new year. Here's a quick rundown of what we'll be discussing today. The bulk of the presentation will be focused on that second bullet, issues and opportunities in U.S. equities. We'll also take a couple questions at the end and perhaps throughout the presentation if time allows. With that, let's go ahead and meet the lineup for today's webinar. Your presenters for today will be Christian Greiner, Vice President at Ziegler Capital Management and Portfolio Manager of the Azzad Ethical Fund. Christian is going to be joining us momentarily to offer up his perspective on the year that was and where to look for growth going forward. I'm Josh Brockwell, Communications Director here at Azzad. A quick word from our sponsor, just to give you a little background about Azzad. We're a boutique firm located outside Washington, D.C., investment advisor to the Azzad Mutual Funds, and sponsor of the Azzad Ethical Wrap Program, a wealth management solution. And now the Azzad philosophy. We're a little different from other advisors you may come across. One of the main reasons for that is our dual mission philosophy, and that focuses on generating competitive long-term financial returns while using investment capital to promote a sustainable economy and positive social impact. We're members of AOFI, the Accounting and Auditing Organization for Islamic Financial Institutions, US CIF, the Forum for Sustainable and Responsible Investment, and the ICCR, the Interfaith Center on Corporate Responsibility. With that, let's now turn to the first section of today's presentation, what things look like right now. Bear with us as these first few slides may be a little bit complicated, but they're important for making the case that stocks may be fairly valued or in some cases undervalued using certain metrics. I'll turn things over now to Christian Greiner joining us from Chicago.
Well, thank you, Josh. As you said earlier, there's a lot going on in these first couple slides, and we're going to try to walk through these as slow as possible to give everybody a good chance to take a look at these. So when we talk about the market, I always like to start discussions like this about where the market is as represented by the S&P 500 by offering a bit of historical context. This chart from JP Morgan takes a look at how a common metric used to value stocks, the price to earnings ratio, looks compared to past years. The S&P 500, which is comprised of the common stocks of 500 leading companies representing all the industries in the U.S. economy, is currently above its 25-year average at 15.9 times earnings. It's currently sitting at 16.9 times earnings. But we can see that this elevated valuation has really held for the last couple of years. It's taken a dip or two back to the average, but it's come back right back up to this level.
Okay, Christian, so here you're talking about one of the many ways that market observers look at stocks to see if their prices are cheap or expensive, considering the actual value of the company. The logic, of course, being that stocks eventually revert back to their longer-term value or mean, but there are multiple types of metrics for determining if stocks are properly valued, right?
Yes, so that's correct. One that we look at here, as we can see in the box there, is we look at the Shiller PE, which takes the price against the average inflation-adjusted earnings from the previous 10 years. And that's so we get a business cycle or two in there. And we can see that by this measure, the market is a bit more expensive than the average. However, the market is still cheap on a dividend yield, a price to book, and an earnings yield basis. It's fairly valued on a price to cash flow basis. And we know that from the past that at cyclical market tops, valuations can go higher than this for a period of time. The tech bubble of the late 90s is a good example of that.
And so again, the thinking is that stocks could go higher based on these current valuations?
Yes, that's right. This chart from JP Morgan takes a look at past observed 5-year annualized returns for the S&P 500, given a forward PE. At 16.9 times, usually we can expect returns of about 8 to 10% a year on the S&P 500 over the next 5 years. Of course, the past isn't a predictor of future return, but along with our prior chart showing where valuations are being elevated but not stretched, we are still left with a good idea of where we are in this particular bull market.
Okay, so that begs the question, Where should investors be to get that type of potential return?
Within the broader market valuations, we can start to drill down and look at individual sectors to see where there might be some individual opportunities. On a historical basis, using 20-year average price-to-equity ratios, so we get a couple of those market cycles that we were talking about in there. The tech, healthcare, telecom, and real estate sectors look relatively cheap. On the other side of the ledger, the consumer sectors, those being consumer discretionary and consumer staples, energy, and financials appear expensive, while industrials and materials, they appear to be fairly valued right now. This is a quick and simple way of looking at it. We aren't looking at earnings growth potential. A sector could be cheap for a reason, or a sector could look expensive at first glance, but have some very good earnings growth prospects that warrant that valuation level. Finally, in every sector, there may be some compelling values.
Okay, Christian, one thing we've talked about in previous webinars is an earning recession, which is, of course, that period during an economic expansion when profit growth takes a break or sometimes even goes negative. Can you comment on that?
Sure. So we've had an earnings recession for the last 6 to 8 quarters, depending on your measure of profits for the S&P 500. Now, as our current economic expansion hits the 90-month mark, it looks like profit growth is back again, with analysts forecasting about 20% growth for the S&P 500, growth in profits that would be for the S&P 500 for 2017. Those numbers are usually notoriously optimistic, and they come down as the year progresses. For reference here at Ziegler, we are forecasting about 12% earnings growth for the S&P 500 in 2017. That's below consensus, but it's still higher than the historical average. When we look at it at a little bit of a more granular level, 2017 should see a return to profitability for the energy sector. Tech and healthcare should also see some healthy profit growth as well. The consumer sectors are really, they're the ones that are currently forecast to be the slower growers for the year. So when we start taking a look at all of this in aggregate, we start looking for patterns in past economic expansions and how the market acted during different points. More market observers think that this bull market may be getting a little bit long in the tooth, and they have started really floating out the late cycle playbook. This doesn't necessarily mean that the end is near for this particular bull market. A late cycle market can go on for years, and most recession indicators show that there really isn't any trouble on the near horizon. Still, we may be transitioning from a market where consumer-fueled stocks were the ones that led to a bull market where commodity and business capital expenditure stocks may take over that market leadership. On the right column on the screen, you'll see what many consider to be a good way to position in the late cycle bull market. One should stay away from rate-sensitive names as interest rates rise and get exposed to commodity and capital expenditure names. And then we see a minute or two back that consumer stock earnings growth was expected to lag.
Yes, we did, Christian. And I'll just take a moment to remind our viewers that as part of the ethical and financial screens we follow at Azzad, those utility and tobacco stocks would be filtered out. And those are the ones that you see listed on the right column of your screen. Well, now that we've taken a look at the broader market, let's go ahead and drill down and talk about the U.S. consumer whose spending patterns help shape returns and drive economic activity.
Well, Josh, the U.S. consumer is in pretty good shape. Due to very low interest rates, U.S. households are paying historically little to service their debt. Those low interest rates have also helped them keep down the cost of housing. The U.S. consumer, on balance, has recovered from the financial crisis. Their home's price is back to those peak levels, and their average household net worth is at or near a high.
So, Christian, what kind of mood is the consumer in given that smaller debt load?
Well, as you would expect, they are in a pretty good mood. Here is a chart of the University of Michigan Consumer Sentiment Survey, a survey that a lot of economists and financial professionals look at to measure this. And this shows that, indeed, consumers are feeling about as confident as they have since the financial crisis. However, this does beg the question. With so much supposedly going right, is this as good as it gets, or are there areas where we can get future gains? So the question before us is where future equity gains will come from. I'm not in a business of really putting a year-end target on an equity index. What we are looking for here at Ziegler Capital Management is a pretty big transition now that the earnings recession is over. And that is from a bull market that was driven by multiple expansion. Think about those higher PE ratios that we were seeing in a couple slides back, to one that was driven by that will be driven by actual higher earnings. So the stat on the screen has been making its way through the financial press over the last few weeks and illustrates that this is not just a U.S. market phenomenon. Central banks worldwide have been easing policy, sometimes to the point of negative interest rates. This reduces the risk-free rate that we use to value stocks and allows valuations to go higher, all else held equal. As the U.S. starts to raise rates again and the limits of monetary stimulus have hopefully been reached, it's likely that the next leg higher will come from these multiples being applied to a higher earnings base as conditions improve in the U.S. as well as in some overseas markets.
And let me also jump in here to point out that the stat Christian is referring to is MSCI, and the total return means that dividends were reinvested. Just by way of definition, the MSCI World Index is a broad global equity benchmark representing large and mid-cap equity performance across 23 developed markets, countries. It covers approximately 85% of the stocks in each country, but doesn't offer exposure to emerging markets. And of course, as with any index, it's impossible to invest directly in that benchmark. Moving right along.
Well, one other thing that we can take a look at here as a driver of possible future earnings growth other than increased economic activity would be a decreased U.S. corporate tax rate. As this chart shows, most developed economies have seen a reduction in their corporate tax rates over the last 10 years, while the U.S., which is already higher than average, stood pat. Therefore, they saw this disadvantage grow compared to their developed economy peers. And this has had many ramifications, from companies refusing to repatriate their earnings in foreign domiciles back to the U.S., and we've seen some companies go all the way to moving their country of domicile overseas to pay a lower tax rate. If the U.S. lowers this tax rate, we should see earnings figures jump, possibly driving the market higher. When we look at this in a more detailed basis, domestic-focused companies would benefit most, as would financial and discretionary stocks, which usually pay higher tax rates because a lot of their activity is here within the U.S. Tech stocks and multinational corporations, which usually pay lower tax rates, would see a more muted benefit from this.
Right.
One other thing that we can take a look at in terms of effect on earnings would be the strong U.S. dollar. And above is a 5-year chart of the U.S. dollar index. The strong U.S. dollar has been a thorn in the side of U.S. companies reporting earnings. The stronger dollar on balance means lower dollar-denominated profits in foreign currencies. With the Fed ending quantitative easing, raising interest rates, and the U.S. economy being relatively strong, the dollar has risen. As we can see here from about 2014 on, it's been a pretty solid uptrend. However, recent comments from the Trump administration about the U.S. dollar and its strength hurting the country's competitive position on trade has left some wondering, where does the dollar go from here, and the subsequent effect on U.S. profits. So there are also signs that the U.S. may not be an island in terms of its growth. Above is the J.P. Morgan Market Global PMI, and that measures economic activity, both in services and goods, in developed and developing economies. When this index is above 50, that signals economic expansion. And what we are seeing, and this figure is backed up by country-specific data, is that global economic expansion may be occurring or even accelerating. This could be good for U.S. corporate earnings, where over 40% of S&P 500 earnings are derived from overseas after all.
Okay, so let's turn now to the subject of inflation, which has been making headlines of late, and its potential impact on markets.
So what we have here is a graph of the Consumer Price Index for the United States. This is the whole basket. Sometimes you will see it quoted as being X energy and food to strip out some of the more volatile moves for these commodities. But we prefer looking at it as the whole basket, as a way of measuring price influence on consumers. We can see here that after dipping below zero, and that would mean into slight deflation territory in 2015 because of lower gasoline and energy prices, we've started to see a steady move upwards. The energy CPI bottomed out in February 2016. As higher gasoline prices started to lap this measure, we should see that the CPI start to top 3% over the next couple of months.
Okay, Christian, for a good part of this last decade, though, we haven't really talked much about inflation. Instead, as you pointed out, we were worried more about deflation as global growth was stuck in neutral. So now that we have quantitative easing having left a large amount of money in the economy and signs of growth returning, as you just pointed out in those previous slides, should we now be concerned about inflation?
Well, that's a good question. So the definition on the screen is really a quick walkthrough of the phenomenon of inflation. For inflation to occur, the velocity of money, that is how often money circulates through the economy due to increased activity, must go up. More money must be chasing after the same amount of goods and services. The velocity of money, however, has plummeted over the last 10 or 15 years, and many wonder if or when it will return. However, the question remains, if we have an excess amount of liquidity out there in the system thanks to quantitative easing, and we see the velocity of money finally increase, could we have a fuel for rising inflation? And the quick appearance of inflation does have some historical precedent. Noted market historian Jim Grant recently called attention to a period in the 1940s and 50s when the market had many of the same interest rate conditions as it does today in terms of the level and the slope of the yield curve. Inflation appeared very quickly and it hit 8%. However, for now, we're calling for inflation in the 1.9% to 2.2% range, depending on how you measure it. So what we see here is taking a look where inflation could be coming from in 2017. And really a couple of areas stand out. And a couple will not be surprising to anyone who's in charge of their budget at home. Energy prices are expected to rise by a robust 5%. But since that makes up only 7% of that consumer basket, that shouldn't be felt too much. But energy prices tend to creep into other areas as a cost of production that is passed on to the consumer. The cost of housing continues to rise at an above average pace, as does the cost of medical services. The cost of food continues to decline, as does the cost of other commodities, ex-food and energy. So we use some of this data actually in our investment decisions. The deflation in the price of food can be further broken out. The cost of a basket of groceries is down as much as 2% year over year, according to some estimates. That makes it more appealing for the consumer to stay in and cook rather than go out to eat at restaurants. And that's a pain that's currently being reflected in some restaurant industry stocks.
Right.
So the Federal Reserve has reiterated time and time again over the last 4 years that it sees 2% inflation as the optimum level. And it communicates that as a way to keep the public's expectations about inflation anchored. While no one wants to see the high levels of inflation or uncertainty that we saw from the 1970s and the early 1980s, we must also be on the lookout for price deflation, which brings problems with wages, prices, and asset values that can be very destabilizing to an economy in their own right. So another measure of inflation is the Fed's stated measure of how they like to look at inflation, and that is the core PCE, a measure that is released along with the GDP on a quarterly basis. This is a measure of what the consumer pays for, ex-food and energy. The release is interesting as it breaks what you and I buy into about 100 so categories and looks how prices changed over that quarter. And they break this down from the price of automobiles all the way to the price of luggage. This measure is still showing inflation at under 2%. In the simplest terms right now, what we're seeing is that strong dollar restraining the prices for imported consumer goods. The data backs this up. December, we saw consumer goods ex-autos fall by 0.3%. And that's the second month in a row that we saw that type of decline with such a drop. And while imported autos, they fell 0.1%.
Okay, and that brings us to the last portion of today's presentation, what to watch out for in 2017.
So when I talk to company managements, I always end up coming back to the same question, and that is what keeps you up at night? Company presentations often focus, of course, on the rosier parts of their business, and I always want to hear about what might be weighing on their minds. Our final section here will let you know about a couple things that keep us up at nights here in Chicago. One factor to watch for in terms of inflation is employment and wage pressure, which could be drivers of inflation. A lot has been made of the labor market being near full employment. Simply stated, that those who want a job have one. One can take exception to the quality of jobs and the number of people that were working part-time who want full-time work, especially during this recovery. However, the number of those types of workers, along with those who are seeking work but are discouraged, that has been falling. And this is commonly referred to as slack in the workforce. And there are some pretty concrete signs that this is falling at a pretty nice pace. So as we run out of workers to hire, the next logical step is to offer higher pay to attract a quality of worker that fits the position that you're trying to fill. And once again, we're seeing some pretty good signs that the labor market is really firming up. Along with the unemployment figure, we also look at hourly wage growth. And what we see is that wage growth is at 2.9% year over year. And that's really the highest it's been in 7 years, as employers deal with a workforce at full employment, as well as the prospect of increased orders due to better economic activity. And this is also supported by all kinds of anecdotal data. There was a really interesting article a couple weeks back about recruiters in the fast food industry trying to poach each other's best workers using bonuses and better hours, to the above quote from the latest Beige Book that the Fed released. The Beige Book gives some color to the economic conditions of each region of the country. And as we can see, wage pressures have increased, and other pricing pressures have gone up as well, and this could contribute to higher inflation. Another nice illustration here is, of course, the famous Fed dot plots chart. In an effort to increase transparency, voting members of the Federal Open Market Committee plot where they think that the Fed funds rate will be at the end of various years. On this particular chart here, we have 2017, 2018, 2019, and beyond. And each individual view on the committee's, each one of their views is one of these dots. So the green line is the median of those dots. The red line is where the market was pricing in, where the market thought it would be at that point where the meeting occurred. And the purple line is where the market is currently pricing it in. As you can see, the market doesn't think that the Fed will keep up the pace of rate hikes that the FOMC believes that they will. So the Fed's dot plot here is pricing in close to 3 25 basis point rate hikes in 2017, while most market participants see around 2. Last Wednesday, the market was roiled when Fed Chair Yellen made comments that she might be in the 3 hikes camp. Previously, she had showed that she was willing to let the economy run hot for a while and not raise rates as quickly as some had deemed warranted.
Okay, Christian, thanks. And this looks like a list of items to watch for with the Fed on our screens now. Some of these were the same concerns in 2016, I see, and some of those look new. The first of these rate hikes you just discussed, can we quickly go through those others?
Sure, no problem. So the Federal Reserve's balance sheet is the next concern. When the Fed finally let its $4.5 trillion in treasuries and government mortgage-backed securities run off and go back to a relatively small balance sheet, as well as controlling interest rates through the supply of bank reserves? Or will it continue to operate with a large balance sheet and control those interest rates through some rather unconventional measures that we've seen over the last 5 years or so? Yellen has stated that she wants to shrink the balance sheet over time, letting it run off as those securities mature. And the final notion is what the Fed will look like in a year or so. Fed Chair Yellen and Vice Chair Stanley Fischer's terms expire next year, but that doesn't mean that speculation about if they will stay or who their replacements might be, that won't heat up. Yellen has stated that she wants to finish her term, but that could change. For now, our new president can immediately nominate 2 people to fill vacancies on the Fed's Board of Governors. And that will really give us some insight into the administration's future thinking, as well as the direction that the Fed might take.
Well, that's a nice segue for us to transition away from monetary concerns and talk about fiscal concerns going forward.
That's right. So a lot of ink has been spilled about where the new administration's priorities will be, and that could probably be a presentation on its own, to tell you the truth. I've highlighted what could be seen as the top 5 areas of concern for the market with this new administration. The first is what form government spending will take. Will there be cuts, and to where? We've already seen Trump take to Twitter to call out costly aircraft programs at Boeing and Lockheed Martin, and we've seen those stocks react negatively to that. The question is, will other companies that depend on government spending feel similar pressures, from those that provide capital goods to those that provide IT services? The other concern is whether research funding will be cut and what effect that would have on certain names within the tech, the healthcare, and the industrial sectors. Next is what form the highly touted tax reform will take and when the economy will actually see these effects of this. A tax cut can be put into place, but we might not feel the effects for a couple quarters. Will the consumers see this tax cut first, or will corporations? What will the exact timing of this tax cut be? Will it be 2017? Will it be 2018? And what will be the levels of these cuts? For corporate reform, for example, House Republicans and Trump differ on some very key issues. And from our perspective here, watching the markets, has the market already priced these tax cuts in with the recent rally, limiting the upside, or are there further gains to be had? So one sector that may bear extremely close watching is healthcare. If you remember, this sector rallied after the election. It had been seen as really a primary target of a Clinton administration. There has been a lot of talk about repealing the Affordable Care Act and if a credible replacement would be put into place and what that replacement would look like. And decisions like these affect everything within the healthcare space, from hospitals to health insurers to device companies to pharmas. And speaking of pharmas, the recent tough rhetoric from Trump's Twitter on drug prices bears watching in 2017 as well. So on a broader level, the administration's stance on free trade could shake up some long-standing relationships, as we've seen over the last couple of days. What has made the most headlines is talk about jobs fleeing to Mexico and bringing those jobs back. These dramas cause volatility around names within the automobile industry and the industrial sector, among others, and this could lead to some opportunities around those sell-offs. We'll also be watching to see what stance this administration will take on our Pacific Rim trading partners and, of course, China. And the final area that we have to take a look at is the effect on how companies build out their balance sheets and use their capital. And there's some thought that this administration will be more receptive to larger deals that might have otherwise come under some antitrust concerns. It'll also be interesting to see if they will keep up the Obama administration's tough stance on corporate inversion deals. And finally, tax reform could lead to some overseas earnings being brought back at a reduced tax rate. Those earnings could be used to spur more mergers and acquisition activity, or the return of capital to shareholders through the form of dividends or share buybacks. So I'd like to stress that this is not an exhaustive list, and there could be new issues popping up as quickly as 140 characters can be typed out. From here, though, we're going to try to sum this all up.
All right. Well, let's do that. We've covered a lot in a short amount of time. Let's go ahead and move on to how to look at 2017.
So let's take an overview of the market risks and opportunities here. U.S. equities, as we saw at the start of the presentation, are entering their 8th year of a bull market, and odds are we're probably entering the later parts of the market cycle. Valuations are elevated, but they're not at their historical peaks, and we're looking at different sectors like tech where they're still below their long-term average PEs. Still, the late cycle playbook tells us to look at commodities and materials, energy and industrial sectors as possible outperformers. Gains might be tougher for some of the consumer sectors after extended bull run within that space. The idea that monetary stimulus might be receding means that rising multiples that raised all boats may be coming to an end. One may need to start looking at companies with good quality earnings as a differentiator within this market. Inflation remains subdued, but between full employment, wage pressures, and that increased monetary base, the ingredients are there for higher inflation. Interest rates remain low, but are rising within the U.S. The U.S. Federal Reserve is one of the few central banks to be raising rates. This shouldn't be too much of a concern yet. Historically, high rates have not started harming equities until the U.S. Treasury yield gets above 5%. That 10-year U.S. Treasury yield is currently around 2.5%. Of course, we're going to have to keep a close eye on Washington, D.C. this year with moves from the Federal Reserve, as well as our new presidential administration having the capability to move markets very quickly. And finally, we must not forget the global nature of markets. While the U.S. recovery appears to be taking root, and that could be a boon for demand for some other economies, we see signs that global growth is accelerating. And for the sake of time, we really didn't touch on a lot of international issues very much today. But let me mention that the Eurozone is slowly coming out of their economic slump, but political instability there could threaten future prosperity. And perhaps most importantly, China remains a series of delicate balancing acts between its export engine that had fueled its expansion over the last generation or so, and their transition to fueling further expansion through domestic consumption. There's concerns over their currency strength, and there's also concerns over their burgeoning credit balances within the country. Throw onto all of this the complication of their trade relationship with the U.S., and you can see why many market observers are watching the world's second largest economy very closely.
Okay, Christian, thank you. That's going to bring us to the question and answer portion of today's presentation. I'll go ahead and kick things off with a question we often see here at Azzad about Dow at 20,000. I say often because it's been approaching that level for some time, just recently attained it. In your view, is this a momentous occasion? Is it psychological, something in between? What are your thoughts?
Well, to tell you the truth, Josh, we really don't know. This is something where the psychological implications could be rather great. We've seen that this is a market where we haven't seen that hasn't captured the general public's imagination. And once they see Dow 20,000, that might have people think, I need to go out and buy stocks. But overall, over the long term, this is a milestone, but we've passed them before, and we'll see what the impact is from 3-6 months out, and that demand for U.S. equities.
Okay, and in the interest of time, we'll take one more question, which has to do with the impact of potential infrastructure plans by the new administration on inflation. Is that a concern for you?
Well, that is a concern, and this is something that's been debated a lot within the financial and economic press here. So we saw that the economy is at full employment, and so one of the areas where they're having trouble finding new workers is the construction industry. So if we are bringing in this infrastructure project, we're going to need a whole bunch of people to work in those construction jobs, and we're not sure we have those people out there. So to get people to work on those jobs, we might see wages go up as people say, I have a job opening, what does it have to pay? And they continue to throw money at that relatively smaller pool of workers. There's an argument to be made, of course, that this infrastructure program would have been better served in 2009 or 2010 when the economy had a little bit more slack within the workforce. So that's something that the Fed will watch, is if this infrastructure plan is passed and what the effect on wages will be in certain key industries, as well as the effects on certain key prices of the materials that go into that.
Okay, thanks. We'll have to leave it there. That concludes today's presentation. Thank you for your time. I'd like to thank Christian Greiner for being with us today. Please visit our website, azzadfunds.com, where you can download and read your copy of the prospectus for the Azzad Ethical Fund. It contains information about the fund's risks, expenses, and investment strategy. While you're at azzadfunds.com, you can also sign up to receive our monthly e-newsletter to get more information about our products and services. Finally, be sure to follow us on Twitter, @AzzadFunds is the handle, and like our Facebook page, facebook.com/AzzadFunds. Let me also note that a recorded version of this presentation will be posted to our YouTube channel, youtube.com/AzzadFunds, very soon. So be sure to take a look, and thank you for your time. Have a great day. Thank you, Christian.
Thank you, Josh.